Are you surprised at the volatility this year? And is that normal at this stage in a bull market?
We're not surprised at the volatility this year. I think some clients might be, only because what you saw last year, stocks were not very volatile at all. Very low levels of volatility. Yes, this year stocks are more volatile than last year, but when you compare the volatility of this year to average levels of volatility, it's about average. There's nothing really extraordinary about volatility this year. I think one of the things that clients often mistake volatility for market returns. And this year the market hasn't been up huge or hasn't been down huge. And when you compare the return pattern of the market this year to the return pattern of last year, people sometimes confuse that with higher levels of volatility.
The other thing that people do is they feel volatility in the near present, and they forget about volatility of the past. And actually, in my lifetime, volatility has been irregularly decreasing, not increasing. People don't think of it that way because they forget about that distant past that was volatile. But if you go back and look at history, 20 years ago, 40 years ago, and then before my time, 60 years ago and 80 years ago, markets were much more volatile than they are now. Markets with all of the varied participants from all over the world and all of the varied instruments that allow people to trade the same things against each other with more liquidity have actually made markets less volatile. It's just whatever volatility we have now that picks up a little bit from what we had just a little bit before makes people feel like, oh, this is just a lot of volatility. Markets are not very volatile these days.
And in a lot of ways, what we've seen this year, particularly early in the year, really was a classic correction in the midst of an ongoing bull market. I mean, if you remember, this year got off to a great start. The first month or so was phenomenal. Then you had a real steep drop in the market. And then you've had a somewhat of a gradual recovery, but it's got all the characteristics you usually see in a correction. Remember, a correction is a short, sharp, steep drop in stock prices, usually features one or several big scary stories that get blown out of proportion, and then ultimately investors get over those types of concerns. And so this time around you had the big short, steep drop initially. I mean, you had the bulk of the drop in this market early on happen in just a number of days, actually. It was really dramatic. And it was tied to concerns about inflation and interest rates, and that morphed into fears about trade and tariffs. But slowly but surely the market's been recovering from that. So yes, this has been a slightly more volatile year, although not abnormally volatile, but we think this has been a classic correction year in the midst of an ongoing bull market.
This is just about the most weak, feeble-minded correction that you could possibly imagine. The scale of corrections in history, this just barely qualified to be negative enough to be a correction. And to Mike's point, this correction took sentiment way down relative to the size of the correction. The fact is that normally you need to have a much bigger correction to take people and move them down in sentiment as much as this one did. And that, as Mike pointed out, is very bullish, that this relatively meager little correction in the scale of historical corrections could set back sentiment enough to create kind of a refresh so the market could move forward. That's a pretty nice statement about what may be ahead.
For views on current events in the world of investing, visit MarketMinder.com. Updated daily, it offers on-demand access to Fisher Investments' most current thoughts on capital markets and the global economy, as well as our sometimes irreverent commentary. We hope you will enjoy it.